Hello to everyone. It's a pleasure to address the 2023 Corporate Governance Conference. And let me thank the Securities Investors Association of Singapore, SIAS, and particularly David Gerald for the invitation and for organizing the event. I'm always happy to attend the event, both physically and then in the last years only remotely. Now, my remarks, you are in a sense lucky because we'll focus mainly on the revised G20 OECD principles of corporate governance, which include also a new chapter on sustainability. And we have just, presented to the public after the endorsement by the G20 Leaders Summit in Delhi a couple of weeks ago. By the way, you will find also all the material related to the update of the principles on our website. Now, the role of the principles, and you are expert on that, and this audience we have already been discussing many times, is really to help policymakers evaluate and improve the legal, regulatory, and institutional framework for corporate governance. Now, to date, 53 jurisdictions have adhered to the principles, including not only all OECD countries, but also all G20 and Financial Stability Board members. The recent revision of the principles has ensured that they remain the leading global standard for corporate governance. And notably, a key component has entailed addressing sustainability issues, which is becoming increasingly important in this realm and is one of the topic where the conference, your conference, has focused and will focus. Now, the principles have 6 pillars. Namely, first, the basis for an effective corporate governance framework, the big framework. The second one is the rights and equitable treatment of shareholders and key ownership functions. The third is institutional investors, stock markets, and other intermediaries. The fourth is disclosure, an essential part of financial markets, disclosure and transparency. The fifth is the responsibility of the board. And the sixth is actually sustainability and resilience. So a new pillar that also fully incorporates the principles treatment of shareholders, which was previously in another principle. Now, in addition, it's important to understand that the corporate governance principles have 3 strategic objectives. So namely, to promote access to finance, to provide a framework to protect investors, and to support corporate sector sustainability and resilience. Now, given the scope of this speech, I will focus first on corporate governance sector sustainability and resilience, and then I will also mention the other one. Now, first, the key objective of good corporate governance is to support sustainability, corporate sector sustainability and resilience. Why? Because this in turn contributes to the sustainability and resilience of the broader economy. Now, this has led to the biggest overall change in the principles. So there is a new chapter on sustainability and resilience. Now, the new recommendations focus on 3 major issues: the disclosure of sustainability-related information, the responsibilities of the board on sustainability matters, and the dialogue between a company and its shareholders and stakeholders on sustainability. Now, on disclosure, the principles basically provide guidance on the hot issue of the concept of materiality, support adherence to internationally recognized standards that facilitate the comparability of sustainability-related disclosure across companies and markets, aim to ensure that verifiable metrics are disclosed if a company publicly sets a sustainability-related goal or target. And finally, they recommend the phasing in of external assurance to provide an objective assessment of a company's sustainability-related disclosure. Concerning the responsibilities of the board, now the principles recommend that when fulfilling their key functions, boards should ensure that they also consider, taking into account, material sustainability matters. And lastly, the principles promote dialogue between a company, its shareholders, and stakeholders on sustainability matters. And this dialogue is essential to inform management's decision-making and to build investor trust in a long-term business strategy. Finally, a key cross-cutting focus of the revisions relevant to all the objectives I mentioned is to ensure accountability of board members and executives. And actually, Principle 5 of the corporate governance principle states that the corporate governance framework, I'm quoting, should ensure the strategic guidance of the company, the effective monitoring of management by the board, and the board's accountability to the company and the shareholders. And actually, the new recommendation on boards address also a broad range of issues, reflecting the increasing scope and complexity of the issues that they are expected to manage. Now, first, and we discussed it a lot, and there is an important debate all over the world, in the academia, practitioners, regulators. Now, the principles recommend that boards consider stakeholder interest when making business decisions in the interest of a company's long-term success and performance, and in the interest of its shareholders. Second, the principles reflect the growing use of board committees while emphasizing flexibility in their establishment. Third, they emphasize the responsibilities of boards in risk management, including for company groups and digital security risks. Fourth, very importantly, they reflect increasing diversity considerations in board composition and senior management, and recognize the value of diversity, and in particular of gender diversity. Fifth, they recommend the use of safe harbors for management and board member actions, such as the business judgment rule introduced this time in the principles. And finally, they provide new provisions on remuneration, so notably on the use of sustainability indicators. Now, as I mentioned before, it's important to understand one of the two other main objectives of the principles, which is promote access to finance. So in addition to sustainability, we think that good corporate governance and members also promotes access to finance, so particularly from capital markets. Why? Because good corporate governance makes access to finance cheaper, other things being equal, by making business conditions more attractive for both companies and investors. And obviously, this promotes innovation, productivity, and entrepreneurship, and more broadly, economic dynamism. Now, as capital flows are global, having an updated global corporate governance standard that supports access to finance is really crucial, very important. Why? We have discussed actually in the previous edition of the conference, now we have more or less at the end of 2022, around 44,000 listed companies in the world. But actually, the number of listed companies in most advanced economies has really declined, except in Asia, actually. In many Asian markets like yours, company groups also are a feature playing an important role, often operating in multiple jurisdictions. And meanwhile, interestingly, institutional investors have become the largest owners of listed companies globally, so investing a large share of their portfolio also in foreign markets, which is a good sign of integration. But so with such important shifts in global markets, now it's critical to have a global standard that reflects these trends and provides a coherent and consistent framework that helps corporations and investors operate internationally. Now, to widen and simplify access to finance, now the principles also recommend flexibility and proportionality for smaller listed companies, and also due in case of different circumstances. Now, to address these trends, the principles include new recommendations, actually, namely, to promote a clear regulatory framework for company groups, which also in Asia is an important issue, as I mentioned. And in order to do that, they recommend that jurisdiction develop a definition and criteria for the oversight of such structure, a topic which OECD has been also interested in, and also due to our tax proposals. Now, to reflect the growing importance of institutional investors, also they encourage using stewardship codes to promote shareholder engagement and strengthening institutional investors' disclosure of their engagement and voting policies. The principles also address the increasing importance of bondholders in markets and the implication for corporate governance, first time. And finally, they reflect also the increasing use of proxy advisors, index providers, and ESG data and ratings. Now, they principles aim to minimize conflict of interest that might compromise the integrity of the analysis of these entities and also their advice. So in order to promote transparency of their methodologies for ratings and indices. And lastly, as I mentioned at the beginning, the third main objective is to promote a framework to protect investors. Last but not least, obviously, and I'm biased by my past of securities regulator. So corporate governance provides a framework for investor protection, but including, really households, citizens, and pensioners with invested savings. Now, protecting shareholder rights, actual and prospective shareholders, and ensuring equitable treatment of all its shareholders will ensure that they are able to benefit from the growth of listed companies. So either directly as retail investors or indirectly when they invest through pensions and investment funds. Now, to help protect shareholder rights, including minority and foreign shareholders, the principles recommend first, defining basically a set of basic rights to access information, participate, and vote on key matters, even in this virtual or hybrid world. Then guaranteeing a proper oversight and disclosure of related party transactions to ensure fair treatment of all shareholders. Also ensuring effective enforcement against insider trading and other violations of shareholder rights, which can undermine also market confidence. And ensuring disclosure that provides investors with quality information to support their assessment of a company value and investment or their voting decisions. Now, to reinforce strengthening investor protection, the revised principles basically do many things, but in particular, I just mentioned, include, for example, a new basic shareholder right to elect, appoint, or approve the external auditor. Remember that this is an international standard. Seek to ensure also that remote shareholder participation in virtual and hybrid shareholder meetings guarantees equal access to information and also engagement opportunities. They also aim to ensure that the rights of minority shareholders are protected in company groups through the disclosure of capital structures, group structures, and control arrangements to also support an effective oversight of related party transactions. And also promote the use of enforceable and clearly defined covenants in debt contracts. As a final point, I would like to say a few final words on another report we recently released the same day, the 2023 OECD Corporate Governance Factbook, which many of you may know. The Factbook, which we publish every 2 years, complements the principles by tracking how 49 major economies implement the principles. Now, this new edition provides data on several new areas of the principles, including non-corporate sustainability. And so as we move to promoting the implementation of the revised principles, this and future editions of the Factbook will provide an important benchmark to monitor progress. Now, while the OECD can continue to provide analysis and guidance to promote better governance, so we cannot succeed without engaging with our key stakeholders. And so many thanks again to the Securities Investor Association of SIAS, and I look forward to participating possibly in person next year also, because I saw that still, like when I came last time, Ferrari won the Grand Prix, which is always a Formula One, very close to the conference. So thank you very much, and hope to see you soon.